Hello, and welcome to today's Funds Europe webinar entitled Private Capital's Liquid Future, Emerging Trends in Secondary Markets. I am Nicholas Pratt, Technology and Operations Editor at Funds Europe, and your moderator for today's discussion. The rise in private capital has been a defining trend in the investment management world in recent years as investors look further afield for their returns. Traditionally, the private capital market has been illiquid. However, the fact that the asset class has become much more popular to a wider range of investors, both institutional and retail, means that there are different expectations in terms of liquidity. This, in turn, has led participants to look to the secondary markets and the crucial role they play in providing liquidity. Today, we will look at the development of secondary markets in more detail, the benefits they offer, and the challenges involved, such as the impact of market volatility. We will look at the respective role of GPs and LPs and the changing needs of asset allocators. And finally, we will look at the potential role of technology and tokenization specifically in making secondary markets more effective. To do this, we have recruited two experts, Benjamin Baumann, Global Head of Secondaries at Mercer Investments, and Antoine Coulson, CEO of IPEM. As you will notice, Benjamin is still yet to join us, so he should be here presently. But before we start, I'm just going to ask both Benjamin and Antoine to briefly explain their role and the work they do in terms of private capital and secondary markets. So Antoine, we'll start with you.
Yes, thanks, Nick. Thanks for having us. So Antoine Coulson, I run the IPEM business. So IPEM, we've been organizing what have now become the largest private market conferences in Europe and as well in the US and Asia now, connecting private capital fund managers that we call GPs in our jargon, general partners, and their investors that we call LPs. So we are really like organizing large fundraising events for private capital across asset classes. Obviously, private equity buyout has been core to our story, to our development since we started in 2016, but we've also expanded materially into venture growth capital, into private credit, into infrastructure. And the secondary market, it's something I've witnessed across, in the last 4 or 5 years now, have really become mainstream and instrumental in the way private markets evolve and innovate. And there's much happening right now in this segment. So I'm glad to talk about it today with you, Nick. And it's something we will be covering extensively, especially at our September event in Paris in next September 9 and 10 and 11th.
Excellent. Thanks, Antoine. So yes, apologies, we are still just waiting for Benjamin to join us. But before that, maybe we could do some scene setting, Antoine. Maybe you could just give us, I guess, a bit of a background and a bit of a history lesson on what the secondary markets are in private capital, what their primary function is, and I guess how this part of the market has evolved in recent years.
Yeah, sure. I think first thing to keep in mind is that private markets are by definition illiquid. LPs that have been, at least at the beginning, large, sophisticated institutional investors, accepted from the beginning that their investments would be illiquid for 8-10 years plus. That's by definition how private equity, private credit, private infrastructure, etc. work. But doesn't mean this illiquidity is set and done and nothing can be done about it. And so that's where, and when the innovation of secondary markets appeared, I wish Benjamin was there because I know he's knowledgeable about that. I think the very first secondary market funds were actually in venture capital, which most people may not be aware of. And I think it was probably in the 70s, something like that in the US. And the idea or the way secondary markets were pioneered was to provide liquidity to LPs. So to let LPs sell their position in private capital funds to a secondary investor, which, by the way, is a fund as well, a secondary fund. And so there are many pioneers in the US, in Europe, and it's become a very significant industry because it's also grew alongside private capital. Consider that probably the turnover in secondary markets, probably 2% of private capital AUM. So it's, I think in private equity, close to 140, 150 billion a year. So it's quite large and significant, but compared to the overall private capital industry, it's still very nimble. But as private equity, private capital grew 15-20% a year over the last 2 decades, the market has really become a large one.
Sure. And was the I guess the dot-com crash of 2000 was that sort of a pivotal moment in that I guess you had a lot of investors suddenly looking to get out or in of their investments?
I was barely born,
Sorry, I'm aging myself. I was only 3 at the time.
Yeah, I know this question was meant for Benjamin. No, I think times of crisis, times of volatility are also when liquidity is scarce. There's a run for liquidity. I think it's now become a mantra of Mark Rowan, the CEO of Apollo. And there are many videos around that you can watch, and I recommend our audience watches because they're great. And I think his point is that when markets are booming, growing, not many people need really liquidity. And liquidity is available kind of everywhere because there's always one person to buy your assets. It's less the case when markets crash, and it's the case both in public and private markets. And so I think probably the dot-com crisis or the GFC, and right now for other reasons, when volatility is high or markets are kind of in limbo, liquidity options are more in demand than before.
I see. Great. So maybe just to continue the scene setting, we could talk about the relationship between private capital and liquidity, and I guess how that has changed as the demographics of the investors or the participants in this market has changed, I guess, away from that traditional private capital investor to, I guess, a newer mainstream sort of participant.
Well, I think it's first important to focus on these traditional, sophisticated, institutional investors, even before mentioning retail investors that obviously have new liquidity needs. The fact is that private capital has grown so much that some LPs, some investors have really mature programs with dozens, if not hundreds of GPs and funds. And vintages as well. So some may have like 2018 or 2020 or 2016 fund vintages across Europe, Asia, US, private credit, venture growth, etc. So these institutional portfolios have really grown in sophistication. And it's no surprise that as the sector and investors mature, they have some portfolio management needs. So that's really where I think and how secondary first comes into play. It's providing some portfolio management diversification tools for limited partners. So I think it's really a first. The very reason why this secondary market appeared and developed. In the last few years, and it's a phenomenon we've seen also before, because of market, especially public markets challenges, some investors were under regulatory pressure because of their over allocation to private capital. And so this also triggered another move and another, I would say, another move from investors towards liquidity option and secondary markets. So I would say these are probably the basics underlying the secondary market. More recently, and this is a new phenomenon, relatively new, because the number of exits, especially in buyout, is down 50% compared to last year, because there are less deals being done and distributions happening. The levels of distributions to LPs is probably now to its lowest level in decades. Some estimate it's about 10% of private capital NAV compared to 25% on average in the last decades. And LPs were obviously expecting these distributions to happen, and they're not. And as a consequence, GPs as well were expecting to distribute fresh capital to LPs in order to raise the next vintage, their next fund. So that's, I think, a context, the current context that's driving a rush to liquidity and a rush to liquidity innovation. Not only these, I would say, traditional secondary market where LPs are selling their stakes in some private capital funds, but also leading to GP-led secondaries, which we've seen some growth around, as well as more creative ways to provide liquidity to LPs.
I see. And those sort of low levels or those challenges around capital raising, I guess, is due to the general sort of market uncertainty, political uncertainty, and some of these kind of just macro tension.
Well, markets don't like uncertainty, so this is for sure one reason. There've been several of them in the last 2 years. Valuations are one, because many deals, especially those, I would call them the 2020 vintages. So, you know, the post-COVID vintages in particular, many deals were struck at very high valuations. And so it's hard to get the exact same level and price just a few years afterwards. So there's much work being done by GPs to, you know, create value and generate returns for their investors, and it won't happen overnight. And so that's why also the length, the duration of portfolio holdings by private equity firms has extended significantly from 4 or 5 years to more than 6 years now. And so it's something to expect, especially for these 2020 and post-2020 vintages where valuations are hard. Another reason why exits did not happen much more last year was the fact that, especially in private equity, financing was hard or scarce, and it was hard to to refinance at higher rates some assets. But this clearly improved in the last few months, and so we can notice, and if you look at news, some large deals being done and some large exits being in the pipe, so that's probably going to change. But anyway, liquidity has been scarce recently.
Yeah. Okay. I guess just to return to the issue of the development of secondary markets, and Benjamin is, I think, going to join us very shortly. But until that point, maybe we could just talk about some of the, I know we touched on some of them already, but some of the GP and LP-led developments that have kind of impacted the private capital asset classes and influenced, I guess, the evolution of secondary markets.
Yes. So I think I mentioned like the traditional secondary transaction where LPs sell their fund stakes to a secondary buyer. GP-leds are probably need to be explained a bit. I think so I hope I'll be clear to explain it. But a GP-led transaction, by definition, is triggered by the GP, and the idea is that the GP takes one or several portfolio companies from an existing fund it already manages to a so-called continuation fund, continuation vehicle. So it's a newly set up fund where capital is either raised from new investors, new LPs, or secondary investors, and or rolled over from the existing LPs of the first fund. So existing LPs that just extend their investment in a particular company in the future. It was 5-6 years ago, about a third of the secondary transactions were of such kind, and the market is much more balanced now, probably 50-50%. So I mentioned this 140 billion transaction a year. Consider 70 billion to be traditional secondary transactions, and 70 billion being GP-led, either single asset or multiple assets put into continuation vehicles. This is, I think, quite an interesting development in the market for a couple of reasons. The first reason is that it feels that GPs have another exit option and can also stick to assets for longer than originally planned. And so it happens quite frequently that the most successful deals, rather than just exiting them 5-6 years after entering, after making the original deal, GPs want to stick with it for longer. One, I think, of the most successful and most public continuation vehicle are the Action stores across Europe, the discount stores across Europe. And I think it's been through a couple of continuation vehicles managed by 3i since the original deal, because it's been such a successful journey for the GP and for the business. And so why sell a business when you can hold for it forever, as Warren Buffett says. So I think this first development is that GPs have now the option to stick with assets for longer, and can see continuation vehicles as a new exit route for their portfolio companies. I think another aspect of these continuation vehicles that has been quite discussed and debated is the fact that obviously the alignment of interest between LPs and GPs has to be super strong, because GPs are basically buying themselves the assets. So there's a price, there's a process discussion. Some LPs, for example, have been criticizing these continuation vehicles either because the price discovery process wasn't clear or transparent enough, or because also existing LPs did not have enough time to roll over or to really decide whether they should continue with the continuation vehicles or take their money off the table, which by the way is the majority. Is what happens in a majority of cases. So this alignment of interest is still being, I think, discussed. I think there are good practices, especially designed by LPs and defined by the ILPA, but as I know it's been an ongoing debate. And it also led to the emergence of GP-led investors. So secondary fund managers that are either in a global secondary mandate invest into traditional secondary transaction and into this GP-led transaction, but you also see a good number of GP-led specialists appearing here and there to support these continuation vehicles. And it's clearly now an exit route for GPs. It's been the case in the large end of the market because it's quite sophisticated.
Yeah.
So, in this mega cap buyout. And I've spotted a couple of news here in France recently where smaller fund managers, small cap fund managers are also now entering this GP-led trend.
I see. Just to go back on one of the points you made, I think it's interesting that you said on the GP-led side, some of the developments in the secondary market will actually lead GPs to invest for longer periods of time. So I guess the general assumption normally is that demand for more liquidity means a more sort of short-term investment outlook, but that's not necessarily the case.
No, I think you can have assets owned and managed for long, for quite a long time, and still have some liquidity options for capital providers, for LPs. It's what we see in the market. You can hold with public, stocks forever if you want, and can sell them overnight or anytime you want. So I think you can have both mechanism. GP is investing for longer while still innovating and providing liquidity to investors when needed. The fact is, to invest in private assets, to create value, generate value, and distribute it to investors, time is gold, and it cannot really happen overnight. And so I think these liquidity options also have to be examined through that lens, the fact that private capital takes time to generate value.
Sure. Now we've got some audience questions that have come in, and I'll caveat that statement with some of these questions might be better directed to Benjamin, who is still on his way. So I'll put them to you, Antoine, and if you want me to put them to Benjamin when he arrives, just say, and we'll sort of move on to the next one. But one of them is, should new funds plan for secondary markets at the fund formation stage, or should this emerge at a later date when LPs request this?
Shouldn't you? Sorry, I'm just trying to understand the question.
So I guess, yeah, do you have secondary markets in mind at the fund formation stage at the very outset, or should thinking of secondary markets be something that you consider, I guess, when that fund has launched and when LPs request it?
I'm not sure to get the exact angle. I mean, a traditional GP evolving in private equity, venture capital, I mean, probably doesn't think at all of secondary market when at fund formation, because it's just another liquidity option like many can be around. So I'm not sure it's something top of mind when funds are designed and launched. I don't know if it's the question, but I see also a growing number of emerging managers in the secondary market. And I see a number of private capital entrepreneurs spotting an opportunity where liquidity is scarce or under. There's a lack of liquidity options in some segments, in some market segments. It's the case in venture and growth, for example. It's the case in some in infrastructure. It's the case in GP-led or in some segments of GP-led, especially in the smaller end of the market. And as private capital grows, I think the need for liquidity is probably everywhere, and there's a lack of solutions in some segments of the market. So I don't know if it's exactly the question, but I think it's worth mentioning the fact that I see a couple of new funds being launched to seize the opportunity.
Yeah. Now we've got a few more audience questions that have come in as well. So I'll come back to these, but one area I wanted to talk about that you brought up before, Antoine, in the lead up to this was semi-liquid solutions, and I guess that idea of a hybrid sort of market of sorts. So yeah, I guess what do you mean by sort of semi-liquid solutions, and how important are these developments?
So I think these products, some have been around for some time, but we clearly see, and it's something we'll be covering, discussing at the IPEM Paris in September, a trend to more product innovation and a growing interest, first from GPs, to designing evergreen, hybrid, or semi-liquid. These terms, probably encompass a variety of solutions. This is mostly driven by the promises of democratization in private capital. The fact that, as I said before, the dominant investors in the asset class were sophisticated institutional investors that had a very long-term perspective and viewpoint, which is different from retail investors, where liquidity becomes even more important. And this run or race, I would say, to wealth management and to retail investors in private capital is really happening right now. GPs are expecting to raise probably their next 10 trillion of AUM in retail, and retail investors need probably new solutions, especially on the liquidity side. And you can spot different innovation, and there's no, or I wouldn't say there is right now a market standard winning. I think hybrid funds are an interesting solution where within the same vehicle, you can hold both liquid assets, publicly traded securities, and private assets. And so these liquid pockets in the fund are designed to provide liquidity to existing investors who may want to redeem or to exit their position. So that's, I think, the hybrid way, if I'm correct. I'm not an expert. Then the semi-liquid or evergreen solutions, many of them are being launched, and some have been quite successful, especially in real estate and private credit, are funds for which the investment is supposed to be like forever, but for which the fund manager can provide, to some extent, some liquidity. So the fund manager needs proper balance sheet to be able to provide liquidity to their investors. This can be the asset manager, or can be, in some cases as well, the insurance company that distributes the product, or the pension plan. I think it's probably right now where I see much move, but no market standard, and no really. I mean, it's relatively new, so no one can really see whether it will be like a dominant solution. Clearly, what it means is that the closed-end, illiquid private capital fund that at least was the standard has been the standard for decades, is challenged by product innovation. So we'll see where it goes.
Yeah, but I guess, is it fair to say that there is still a traditional market of long-term private capital investors that will probably stick with that standard, but it's the influx of new investors that will drive the innovation?
Yeah, sure. I mean, to a large extent, these traditional institutional investors, are liability driven, have long-term views on the asset class and their investments, and can afford illiquidity because also it comes with higher returns. I think the key question with these semi-liquid hybrid funds is the impact such innovations have on a return, because you cannot expect the same return when you blend private public assets or when liquidity is accessible whenever you want. It's obviously it comes at some cost, and this cost is ultimately borne by the investor. So I think the key question is whether this new product can deliver the same level of returns.
Sure, thanks, Antoine. So yes, now apologies, we are still waiting for Benjamin, but I'm sure he will be here presently. So I might leave some more of the audience questions until Benjamin is here, because I think he's ideally placed to answer some of them. But in the meantime, maybe we could look at the sort of operations and technology side of things. And I guess what role will technology play in the future development of secondary markets and tokenization specifically? But I guess if we look at just sort of general technology and automation and operational efficiency first, that the private capital as an asset class is always traditionally seen, I guess, as less standardized and less advanced than, say, equity markets or other markets. And I guess part of that is the assets themselves tend to be more unique, illiquid, and less standardized. So is that sort of still the case, or are you seeing an impact from just automation and more operational standards in the asset class?
It's interesting because it's something most players have been expected for a very long time. In the fact that these secondary transactions and markets would move easily into marketplaces and more transactional, liquid, efficient types of transactions. The truth is it's not been the case that much. There are some marketplaces around. Palico is probably one of the most established, but I think their market share is still limited to what everyone could expect. So I think innovation and technology could drive secondary markets higher, but right now it's still much intermediated and quite, I would say, a long, not a long, but I think a traditional process to market, stakes in funds or GP-led transactions. But it may change, and I think a couple of examples that I can think of is, I think the first thing is in tech, in VC. If you look at solutions such as Carta or Rainmaker, it's interesting because some privately owned startups, unicorns such as SpaceX, you can buy shares in them in private markets through some of these platforms. I think last year about 4 billion of SpaceX shares have been traded on this solution. So I think the boundaries between private and public markets, especially if there are some regulatory evolutions in the future, could change quite significantly. And to your point with tokenization and blockchain technology, I think I haven't seen much of it happening apart from perhaps the fund servicing industries, which is implementing it in private markets, in public markets, etc. I think a couple of firms such as Apollo are exploring using blockchain technology, especially in their CLOs businesses, but I think it's really nascent, and I have no feedback about how successful these operations are.
Yes, because I mean, tokenization, it is, I guess for a long time, it's been labeled as a a solution looking for a problem. But the private secondary markets in private capital are often sort of earmarked as the most appropriate use case.
It's true. A couple of weeks ago, I did a talk presentation at the INSEAD MBA with young MBA graduates, and I think the top questions I heard was really around blockchain, the impact of blockchain technology on private capital and secondary transaction. So if innovation is not happening yet, it's probably in the pipe. Hey, Benjamin.
Hello, Benjamin.
Hey, Antoine and Nick, so much about technological challenges.
Yeah.
36 minutes of delay.
No problem at all. Maybe just, Benjamin, would you just like to give yourself a very brief introduction and your role in sort of secondary markets? And then we have a whole pile of audience questions that have come in that I think you're ideally placed to answer. So yes, first of all, let me introduce you as Global Head of Secondaries at Mercer Investments. And I guess, could you just give us a very brief history of your involvement with secondary markets?
Yeah, sure, absolutely. So yes, I'm leading secondaries at Mercer globally across the asset classes. Our main focus is really on private equity and infrastructure, where we have dedicated pools of capital dedicated for secondary investments. Opportunistically, we also pursue credit and real estate secondaries, although there is just part of broader allocations to private markets, where secondaries just play a role of, say, about 10 or 20% overall allocation. And yeah, my history, 10 years at Mercer, before another 10 years at a small boutique that was then actually finally acquired by Mercer. So about 20 years now in private markets investing across different asset classes and also different investment types.
I see. And just before we get to the audience questions, I guess, how would you characterize the evolution of secondary markets to, I guess, sort of meet the liquidity challenge that we've seen from new investors coming into this asset class?
Yeah, I mean, it started long years ago, obviously, with private markets just taking off and facing probably the first challenges with the dot-com crisis, and then the next one with GFC, where there were obviously some capital constraints and where secondary markets just offered a solution to provide liquidity finally to LPs. And then obviously over the last, say, 10 years, tremendous growth of private markets overall. That obviously also triggers the secondary growth. Other people may also see it vice versa, that actually secondaries may have contributed to the strong growth of private markets, because obviously it had generated some forms of liquidity and some forms also of getting private markets programs established more quickly. So from that perspective, I think secondaries from an LP-based perspective have created a lot of value add to investors. But then also it's now also about probably 8 years ago or so, when the GP-led market has really started to become more important. I mean, GP-led transactions also exist for longer, but I think in the old days it was more related to some orphaned assets that needed some other home instead of the old funds that they were held in. And then really in 2017, 18, and then particularly throughout COVID, obviously the GP-led market was completely reversed to really focus on trophy assets, on underlying companies that actually show very, very strong growth momentum. And where the GP that just also have seen the growth and business plan going forward for the next 4 or 5 years, that they didn't really want to then give away to other sponsors, right? Because they really thought, okay, we know the company and we know the growth potential of that company. Why can't we not manage it for another 4 or 5 years in a continuation vehicle? And that evolution is really obviously marked the milestone within secondary markets, because nowadays it's almost 50%. I mean, if you take the combined transaction volume over the last 3 years of every year more than 100 million. The peak year was in 21 with 134 billion transaction volume. And GP-leds actually accounted for around about 50%. It was even a bit more than 50% in 21, and then a bit less than 50%, 22, 23. 24 we'll see, but if you look and read through the broker's report, then it's actually another more than 100 billion market, probably transaction market in secondaries this year, with GP-leds probably accounting for 40 to 45%.
I see. Great. Thanks, Benjamin. So we've had a lot of audience questions come in, and I think some of them would be up your street, Benjamin, as the sort of secondaries expert among us. So one of them from Martin Kruner is talks about the different structures of secondaries, say buyout of LP stakes versus purchase of funds assets. So I guess, what are the pros and cons of the different approaches, and what would you say are the preferred structures today?
So if the reference, I'm not sure, is the reference really the distinguishing between LP-leds, GP-leds, secondary directs, structured deals, probably, I guess, right? That's the
yeah. So I guess what are the range of sort of secondary structures out there, and possibly with an eye on what structures do you think will become more preferred in the year to come?
Yeah, so I would view all the different transaction times as very relevant, and they also have their specific field actually that they address within secondaries and also within private markets. If we start with the smaller segments, maybe niche segments like secondary directs, this is a small segment, it's probably just accounting for about 5-10%, but it's still important, right? Because it actually provides liquidity. It's always about providing liquidity. In this instance, it provides liquidity to small minority investors that are directly invested in growth venture companies, right? And there, obviously, if those investors seek liquidity, secondary direct managers can acquire those positions. That can be done on a one-by-one basis. It can also be done as a portfolio. We see different strategies behind it, and it actually creates for buyers in those secondaries direct exposure to strongly growing, but obviously high risk profile, normally tech-related companies. Then we have the traditional LP-leds, which is obviously a market that will persist for longer. That's clear, be it on single LP stakes or also on overall portfolios, portfolio cleanups as well, where we have smaller transactions of maybe just like 3 to 10 million LP stake up to multi-billion transactions of portfolios that actually extend across asset classes, so not only private equity, but also go into real estate, venture, or infrastructure credit. And then we have the GP-leds, and the GP-leds, there is some discussion around it, obviously, because really the focus on those trophy assets that I just mentioned before is younger. It's also about 7-8 years old, as I mentioned, but it is younger. And there is some question around it. Okay, if IPO markets, if M&A transaction activity actually is becoming better again, would then some of that transaction activity potentially fall away? GPs would sell to strategic buyers again, to in secondary buyouts, to other sponsors, instead of just creating the continuation vehicles. And I think to some extent, yes, but that's probably then related to the companies that you wouldn't really want to see in those continuation funds anyways, because those are the companies the GPs may not have full conviction about. Because if they have full conviction about the future business plan, they know obviously the past challenges and also the potential of those companies, they obviously are motivated to go ahead with the continuation fund. So in my view, and we are still in a relatively nascent phase of continuation funds, obviously many LPs know about it, but if you talk to GPs, there are still many GPs that actually didn't do one, but are thinking of the first. So it is still something that there is also additional potential, and overall, I guess LP-leds and GP-leds will hold the balance more or less going forward. In terms of portfolio construction, I mean, there are different possibilities to think about it. There are some GPs or managers that will say, okay, actually, we just want to focus on single asset GP-led transactions. Others would combine single asset and multi-assets. Others, again, would combine multi-asset GP-leds with LP-leds because both are referring to portfolios. And then there are ones just focused on LP-leds. With LP-leds, there's also different angles you can play it, right? If it's like more, say, younger vintage funds where it's more sort of a late primary, you just cut off the first couple of years to effectively avoid the J curve and go a little bit more straight into the value creation phase of the primary funds. Or you play the tail end game, just benefit from the discounts and then just recycle very quickly and create the returns and multiple there. So that is all embedded actually with some different risk return profiles and with different cash flow profiles as well. So depending on where the preference is for investors, they can obviously shift to one or the other element. I wouldn't favor one over the other. It really depends on those on that preference structure of the underlying investors. We think that there is really a very good value across all those different transaction types in secondaries.
Great. So a question for both of you.
If I may, to the earlier question, Nick, I think, and I'd like to know whether Benjamin agrees with what I hear on the market, but I think what both LP and GP-led share, they provide liquidity, they mitigate the J curve because capital is at work very fast, and there's some knowledge around about the underlying asset. It's not like a blank check fund. It's really a fund where you have some knowledge of understanding of what the underlying assets are. What I hear about the LP-led transaction, they are more diversified portfolios. So closer, it may be completely wrong, but it's something I've heard, to index in, to private market index investing sometimes. Whereas GP-led, you're closer to trophy assets, as Benjamin said. So it's sometimes a surrogate to co-investment, or it's more, I would say, a more precise way to access some very specific assets. So that's where I think where the difference is.
Yeah, that's true. And I think that's an important element as well, because particularly when you think about new investors in private markets, it doesn't need to be private equity that is more established already, maybe new investors in infrastructure, for example. If they start, it's a good start for many investors actually to go with those more diversified, so LP stake deals, instead of just like having single asset CV exposures to one or two infrastructure assets, right? So from that perspective, it's certainly more in the desire of LPs as well to get the diversification through those funds. Having said that, I mean, obviously also on the LP-led side, you can play, if it's more mature funds, I called it tail end before, but sometimes it's just like 2 or 3 assets left and they still have some potential as well. So it can be quite concentrated there as well, and can really be an asset play. So it really depends on the opportunity. But generally, and particularly if you play obviously portfolio deals, then it's a diversified beta play. Absolutely.
I see. And we are sort of rapidly getting to the final straight of the webinar. So I just want to try and fit in as many questions as we can in that time. And I guess one of them is about asset classes, and you touched on it just then about it. We've sort of gone beyond private equity. So I guess what new asset classes do you foresee in secondary markets? And if I can relate this to one of the audience questions as well, is there any activity in sort of climate sustainability secondaries, or what are your expectations for that market specifically?
Yes, that's an interesting question. And yes, there is. And actually, we are quite active in it. We don't have a dedicated vehicle just to climate-focused secondaries yet, but we have vehicles on the infrastructure side, for example, that take those elements into very strong consideration, actually, and where we invest not only on secondaries but also on co-investment side. So I think, yes, this is a development, definitely. Infrastructure is obviously beyond private equity, is probably the first that has joined, and it's the second strongest in terms of transaction volume. And then obviously we also have real estate and credit. Credit is strongly growing as well, just in line also with the growth overall, also in the primary market of credit strategies, be it senior, junior mezzanine. It's still overall a small portion of the global transaction volume in secondaries, but it grows quickly, and there are some attractive opportunities there as well. As is with real estate, I think the dynamics are a bit different. Normally, many transactions are more about recapitalizations and so on, joint venture clubs. So it's a bit different style. But on the infra side, it's very similar really to what we see on the private equity side in terms of LP-led deals, in terms of continuation vehicles, maybe with the slight difference that there have been more continuation funds with slightly longer terms, at time with some liquidity options after a certain amount of years, like 10 years and then 15 years again. So you have some of that long-term nature of infrastructure assets embedded in the CV structure, but that is not necessarily the case, right? At times that happens, at times it doesn't. But that's certainly an area. I mean, infrastructure currently is at it's about 7 billion, I think, last year in terms of GP-led volume, 15 billion overall transaction volume. And here also, just with the growth of the asset class, we believe that in the next 3 to 4 years, we'll probably go to 25 to 30 billion transaction volume. And also LP-leds and GP-leds more or less in lockstep. So certainly an interesting area. And as a sub-area, certainly impact plays a role on the renewable side and on the energy transition side. But then also impact obviously can also play a role within more like the private equity side, more almost venture capital deals at times when it's just like impact focused. And actually, if you combine those two areas, it's quite interesting also from a secondaries perspective. And that obviously would then also lead to a possibility, something that we couldn't probably think of a couple of years ago, possibility of actually establishing an SFDR 8 or even 9 compliant secondaries fund, right? Which would be quite unique.
I see. So I'm going to try and fit 2 more questions in, if that's possible. So one of them is, and a couple of people have asked this, about the role of fund platforms in supporting the creation of a secondary market or helping to source secondary market liquidity. So Antoine, do you hear similar questions about that, or is that something you have a view on?
What do you mean by fund platform?
Well, I guess you have on the one hand, you have the likes of Vestima, Allfunds, Euroclear, Funds Place. So I guess those platforms that have the technical infrastructure, but perhaps haven't necessarily been focused on secondary markets or that kind of those kind of asset classes.
Yeah, it's a topic I've tried to tackle, but I think Benjamin is probably a better position. I haven't seen a marketplace really making it into the secondary market, so that but it's probably coming. The question is when, why, and who. But Benjamin is probably more knowledgeable than me.
Yeah, absolutely. As I mean, we look at those marketplace platforms at times, right? But it hasn't really generated a lot of our transaction volume. But there are some, certainly. I mean, Nasdaq came up with their private markets platform, Forge Global as well, and EquityZen, I think, was another one. That is more on the VC side. So there are some of those platforms. And overall, I think just like automation and digitalization will play an important role across private markets and obviously also within secondaries. It starts just like with having EBITDA numbers, maybe from PDF files, and you want to have them into Excel. So those kind of things obviously already are, you have the tools already to do that, but there will be more and more on that end. And I think that's certainly also important, obviously, and will actually divide, because really the successful from the less successful, right? Because the data availability across the consolidated platforms that we see nowadays, that is here, and that's important, I think, to be successful in secondaries. But then it's really also how do you actually make use of that data? And that obviously makes a difference, and there you need to have the right tools And AI obviously helps a lot in that instance as well to really make the step forward. Now, having said that, with all that optimization, it always has a backdrop as well, right? Because sometimes when you think about it, what happens then also with the training of the younger people, because many of those tasks that could be optimized will probably nowadays be taken on, the modeling, the analysis, and so on, the data capturing as well, is something that many times the analysts are doing nowadays. If that is all optimized, if that is all AI, so to speak, then the juniors, it would somehow, you would lose that training ground that is important as well, actually, to gain knowledge and to become a successful investor, right? So it always has like two components, but I think we are certainly going into more automation and digitalization in that regard, and it's important for secondaries now, whether tokenization and so on will take place so quickly, and whether we will just have in 5 years' time an app where we can just buy a fund and then also trade a fund and just do the secondary, because all the data is actually already in the app with all the KYC data and all the relevant investor data. I doubt it if I look into all the legal negotiations that we are pursuing on behalf of our LP-led deals nowadays, but it's certainly a way directionally where it's going.
I see. Great. Thanks, Benjamin. So our hour is almost complete. So I just want to try and fit in one last question, which you could perhaps combine with a sort of a closing comment. And I guess it's probably the most controversial one. So should the illiquid market focus on providing liquidity at all? It is called illiquid for a reason. In a positive market environment, it might be fine, but when the market environment changes, it can cause more problems. So I guess, should we approach creating more liquidity in a liquid market with some caution?
Yes. If you ask me, there is a clear, secondaries are just a tool to provide liquidity, and we will always use that tool, right? And there is no risk about it. So the secondaries are good to do that. But the question is, if an investor just goes into private markets assuming that there is always full liquidity, or using semi-liquid products, I'm not sure whether that has been covered before when I missed the first half hour, then obviously investors need to be aware that that is at a certain cost, right? If you want to avoid that illiquidity. But the secondaries themselves, what they do is effectively just provide that liquidity and shorten the duration, right?
Yeah.
So if you take just the primary fund program and compare it to the secondary fund program, you could probably just halve the duration of those assets being held underlying within the portfolio. But it doesn't mean that you go into long-term asset class companies or assets and then just because of the secondary market, you can go in and out at any point in time without any bid-ask spreads, right? So
yeah. So I guess be realistic about the trade-offs involved.
Exactly.
Great. And Antoine,
we have,
I guess, a closing comment for you on this whole area.
Yeah, I think at the September event we are preparing, we have a session. I think it's probably a quite expected session. Its title is Liquidity Options: The Good, the Bad, and the Ugly.
Right.
And and it's really where we are, I think. Benjamin is right to say that liquidity options are options, right? Doesn't mean that these illiquid markets are supposed to become liquid overnight. But some liquidity solutions may be needed by some investors and fund managers. And some of these options are better than others and may not be systematic. And I think it's really where we are, finding the right balance between long-term illiquid investments that take time to generate value for their investors, while still designing the right level of liquidity when it's needed by the market, by investors and fund managers. Right now, the secondary market, again, is just, I think the turnover is just 2% a year. So it's not really, doesn't really illustrate a very liquid market. It could some hypotheses around are that it grows to 2 to 3 or 4%. So it's not like a pure liquid market overnight, and it's probably the direction, I think.
Sure. So I guess a lot of development to come, and a lot of room for that development to happen. Great. I'd like to thank you both very much for your time. And the recording of the webinar will be available very soon. And like Antoine said, for people that want to know more about this, there is an event in Paris in September. Great. So thanks again, and thanks for watching, and have an enjoyable rest of your day. Thank you.
Thank you, Nick.
Thank you very much. Thank you, Nick.
Thank you all.